Deciding to end a marriage is a complex emotional decision that can also have significant financial consequences for your future. While it's worth noting that many marriages do last for a long time, contrary to popular belief, the divorce rate in the U.S. has been steadily declining over the years. The idea that half of all marriages end in divorce is not accurate. However, for individuals over the age of 50, the divorce rate has actually doubled over time. This is particularly important because older individuals often have more financial resources accumulated over years of work, savings, and home ownership, which means they have a lot at stake. Aside from the impact on your mental and emotional well-being, divorce can have a severe negative effect on your finances. In some cases, there can be a significant decrease in your standard of living, sometimes by double-digit percentages. There is even a possibility of facing poverty as a result of a divorce. If you find that your marriage is becoming strained and you are starting to consider the possibility of divorce, it is crucial to start considering the financial implications involved, as there are many factors to take into account. The initial aspect to consider when thinking about divorce is the actual cost involved. This primarily depends on the level of conflict between the parties. An amicable divorce, where both individuals come together to discuss and divide their assets, can be relatively inexpensive, possibly around $200, or a few $1,000s if you seek professional guidance while maintaining a friendly approach. However, if disagreements persist and legal representation becomes necessary, the cost can rise significantly, sometimes dramatically. On average, a contested divorce can range from $15,000 to $20,000. These expenses may further increase if there are substantial assets involved, or if other complexities arise during the separation process. Therefore, before proceeding with a divorce, it is crucial to ensure that you can manage the financial obligations associated with it. Aside from the costs associated with hiring an attorney, there are various additional fees to consider when going through a divorce. These may include expenses for professionals such as accountants or financial planners who can help with assessing and dividing complex financial assets. Real estate professionals may be necessary if there are properties involved in the divorce, assisting with tasks like selling or transferring ownership. Mediators can also play a role, particularly when the parties struggle to reach agreements, as they facilitate constructive discussions and help find mutually acceptable solutions. Furthermore, it is essential to consider the emotional well-being of both yourself and any children involved, which may involve expenses for therapy sessions. Additionally, if relocation is necessary, the cost of hiring professional movers to assist with the move should be taken into account. Considering these potential additional fees is important when preparing for a divorce, as they contribute to the overall financial impact of the process. In addition to the tangible costs that come with a defined price tag, divorce can entail various less quantifiable expenses. One such cost is the tendency to adopt a fire sale mindset when dividing assets, driven by the desire to complete the process swiftly. Consequently, shared properties may be sold below their actual market value due to the emotional urgency to finalize the separation. Furthermore, there are assets that lack a fixed value, presenting further challenges. For example, consider a scenario where a jointly owned house is valued at $250,000, and there is a shared IRA or another account valued at $250,000 too. At first glance, it may seem fair for each spouse to claim one of these assets. However, it's impossible to predict their future worth. If the local housing market experiences a downturn while the stock market thrives, one party may come to regret the arrangement. Dividing such assets introduces its own complexities and headaches. These less tangible costs of divorce should not be overlooked, as they can have significant long-term implications. It is crucial to carefully consider the potential consequences and seek professional guidance to make informed decisions about asset division. During a divorce, many individuals fail to anticipate the tax implications that can arise. These implications cover a range of considerations. First, it is important to consult a professional to determine the appropriate filing status for your taxes, whether it should be single or head of household. If you are employed, you may need to review your tax withholdings and understand how your new tax bracket will affect you. Additionally, it's crucial to keep in mind that if you receive spousal support, also known as alimony, it is considered taxable income. Conversely, if you are responsible for paying spousal support, you can deduct it from your taxes. Splitting retirement accounts can be a complex process with potential tax implications. When dealing with 401k plans, simply cutting a check to transfer funds can result in a significant tax bill. It is advisable to obtain a qualified domestic relations order, which allows for the tax-efficient transfer of money without incurring substantial taxes. On the other hand, when splitting an IRA, caution must be exercised in how the funds are transferred. Merely issuing a check is not recommended unless you wish to face taxes and penalties. Divorce brings about significant changes to your financial situation. If you were not employed during the marriage, your income can suddenly decrease substantially, even if you receive spousal support. It becomes crucial to quickly assess whether you can sustain yourself on the new income or if you need to explore additional sources of income. Even if your income is comparable to that of your former partner, it still presents a shock because you will now be responsible for supporting the entire lifestyle on only 50% of the income. In reality, you might find yourself supporting more than 100% of the lifestyle due to increased expenses such as childcare, health insurance, and the need to replace the items you didn't take with you during the divorce. Just imagine not only having to purchase a new house but also furnish it. It's essential to plan and adapt to this new financial reality, which may require seeking employment or exploring alternative income streams. Additionally, carefully managing expenses becomes crucial during this transitional period. Divorce can significantly diminish your net worth, often leaving you approximately 30% poorer than when you were married. This financial setback can have long-lasting consequences, not just for your present circumstances, but also for your future. Following a divorce, the risk of inadequate retirement savings becomes considerably higher. The combination of increased bills and expenses, the need to replace assets like a house that you previously owned, and the potential decline in income all contribute to a more uncertain retirement outlook. In the case of joint accounts, particularly credit card accounts, it's important to be aware that you may be held responsible for any debts accumulated by your spouse, even if you had no involvement in the spending. A general rule of thumb is that if your name is on the credit agreement, you should assume liability for the entire debt, regardless of who initiated the transactions. This principle also applies to bank loans, mortgages, and auto loans. It is crucial to gain a clear understanding of all the debts incurred during the marriage and determine who bears ultimate responsibility for them. To protect your financial well-being, it is advisable to gather comprehensive information about joint debts, including credit cards and loans, and work towards resolving these obligations during the divorce process. If you have children, it is important to note that child support payments may need to be made, and in cases where there is a significant income disparity, there may also be an order for spousal support. The specific amounts for child support can vary significantly depending on the state in which you reside, and both child support and spousal support will be influenced by factors such as your post-divorce income levels and the division of assets. Whether you anticipate making or receiving these payments, it is crucial to consider how they will impact your overall financial situation. That's all for today. Thank you for watching. We hope you found the information valuable and insightful. If so, please give us a thumbs up. And to stay updated on our latest videos and receive expert advice on various financial topics, don't forget to subscribe to our channel. See you next time.